morning, everyone. Thanks for being here. Stephen, thanks for doing this. And a big thank you on behalf of my business for making so much news over the last few years. But maybe news that's been somewhat underreported. So I want to maybe get you to sort of, we'll go back to the origins of sort of the acquisition path you've been on for the last few years. First coming to Salvage Home Capital, now the merger that Gary alluded to. Why don't you talk us through what you're thinking there? Is there a grand vision, or is this sort of an ad hoc thing?
No, there's a vision. And I guess I've always been a big believer in the mortgage business from starting First National back in 1988. I saw the opportunity for mortgages, and the first 5 years of that, back in the early 90s, were pretty tough. That's probably the worst real estate recession we've had since the war in Canada. But I think a singular acquisition, and it's not well known because Canada Guarantee is not a consumer-facing brand, but there was the opportunity in 09, 010, AIG was in Canada, and as you know, they had a lot of trouble. And I remember at that time, people were convinced, and it's been a narrative that's been common in Canada and North America, is that the mortgage market is set for a crash. It was set for a crash in 08, 09, 010, 11, 12. In fact, it's still set for crash. You know, if it does crash, it's not going to be things that happened 15 years ago. But Canada Guarantee was the first acquisition where I saw that the strength of the Canadian consumer would be the strength of the mortgage market. So that would be the first acquisition that I looked at. Similar acquisitions over that period of time were from the period of 2012 to 2014, when I saw Equitable Bank, then Equitable Trust at the time, was trading at 5 times earnings and at a discount to book. And good management team. Andrew Moore is one of the leading financial services executive in Canada. He's done just a fabulous job in transforming Equitable Trust into EQ Bank, a challenger bank. And so that was another staged investment. Coming to, I guess, 2022, I think I was strategically at Smith Financial, we said, well, we're long First National, we're long Equitable Bank, we're long Canada Guarantee. Maybe it's time to do something else, maybe outside of Canada. But it was 2 years ago, it was only 2 years ago, Home Capital, somebody said, why don't you look at Home Capital? And you know, what I saw in that is they'd come out at some pretty tough times. 2017. That was a near-death experience for them, but it was like most bank challenges, it was a liquidity challenge, not a solvency channel. And usually Wasada had gone in there as CEO, and he'd done a wonderful job over the 5 years from 17 to 2022 of really turning it around. They had really good results in 2021, and what was start to happen, I thought, this looks like this is good value. OSFI regulated, strong management team, good assets, very comfortable with the assets. Just as a sidebar, B20 had done an excellent job of changing mortgages from just particularly at the non-DSIB institutions back into covenant loans. So they're very, very strong credit underwriting, very strong real estate. And what started to happen in 22 is with the interest rate rise, people convinced that the mortgage market was going to crash, and it started to trade at a discount to book. And I like that business. I liked Home, I liked the management team, I liked the asset class. So it was very much, people were saying they wanted to flee mortgages again. So I saw an opportunity. The stock was trading at 27, did the takeout at 44. It was a big win for the shareholders because they could get a nice premium to book at that time. And I don't think that's dissimilar to a lot of situations that you see where there's a dislocation in the market, where the market's saying it's worth something, but in fact it was worth something else. The surprising thing I saw is that there wasn't a little bit more competition for it, which of course I was relieved about. But I think, to be fair, understanding the Canadian mortgage market, the Alt-A market, is probably, a lot of people aren't in that space, and and still that hangover from 05, 06 subprime crisis, people are convinced that's still happening. And I don't know, it might take a generation or 2 generations. A little bit like your parents or grandparents talking about the Depression. It's probably taken 100 years to get over the Depression. And I think the subprime crisis in the States might be the same thing. So that was there was an opportunity there. There was a win for the shareholders. The negotiations were, as you can imagine, I thought of stock at 27 44 was a bit rich, but the board did a good job of extracting good value. Happy with the purchase, and it's worked out. And then I guess the next step, which happened when I looked at home, I just didn't have a vision any other than it was a standalone acquisition, which a reasonable return. We were still in the midst of really completing all the regulatory requirements for Fairstone Bank. Ontario Teachers and Centerbridge were my partners. They didn't really have an appetite at that time. But fast forward almost 2 years, so that would be at the end of last year, the beginning of this year. It started to make sense. Things happened at home in terms of what I wanted to do a lot more quickly than I thought. So I was in a position that it made sense. And those two businesses are incredibly complementary. Like there's just almost no product overlap. Home is single family Alt-A mortgages and a commercial mortgage book, and no branches, or just distribution branches. And then Fairstone is Canada's leading consumer lender, 250 branches, powers the Walmart rewards card, point of sale business. Very complementary, huge synergies, two great teams. So at that point, it made sense. It made sense to all the shareholders at Fairstone and Smith Financial to put the two businesses together. That was announced in March, with hope we close that sometime before the end of the year, or maybe as early as October.
So is the business proposition around the merger more of an efficiency play?
I would say so.
So you're not seeking to bulk up and grab some market share from the big banks or others, or what's?
I would say it would be fundamentally a synergy play, but the other big advantage would be is Fairstone is actually relatively asset light. It's maybe $5 or $6 billion. And although the net income is in the $300 million range, you get a lot of bang for your buck in the assets. But what it does have access to is $1.7 billion in customers. So it's potentially a great play for a deposit product. So we have 200,000 or 300,000 customers coming in and signing up consumer loans. Perfect way to sell them a transaction account and start to pick up deposits that way. We have I think we have 1.2 million customers for a Walmart's reward card. Warm customers, perfect play for offering competing products both from Home and Fairstone, particularly on the deposit side. So there's a range of synergies from business, but not directly as you would think.
Okay. How do you think about competition in the financial services industry? I mean, I'm sure there are lots of people here that have been trying for the last decade to figure out ways to break into that market, given how tightly it's controlled by the big banks.
Yeah.
You've spent a career figuring out ways and cracks in that fortress. How do you think about it?
I think there's a perception here, because it's a structured, concentrated industry, that there's not competition. It's competitive. I mean, First National is not regulated. We have no barriers to entry. It competes against the DSIPs on a regular basis. It is hard. It is really tough in the mortgage space or in credit cards to get the type of scale and to get the competition. To a DSIP, our banks are really incredibly successful. And you go to the United States and it's entirely different. You have the whole range of consumer banks, and you get maybe one product from one bank and you go somewhere else to get your mortgage, and you have a whole model of wealth where you go to RIAs for your wealth products, and your probably credit card provider is somebody else, and you just have no natural branding. Look at I bet if I put up the hands, who had your tell me your bank account, your bank when you were 15. I bet it's still the same bank, because you go to a bank, it's in your branch, your parents took you to it, and you want to move somewhere else, you can transfer that, and it's even easier now because everyone's sort of moved online. But there is a branch you can go into. They offer a mortgage product, they offer a credit card product, they offer RSP loans, they offer a whole range of type of products. So it makes, you start to get 3 or 4 different ties into products. I think it's very difficult. We also have a capital structure under IRB, which allows them to be very capital efficient. So, most of you know this, but six DSIBs are all under IRB. The smaller banks are under a standardized regime, and the capital that standardized banks have to hold compared for, let's say, a mortgage product compared to the DSIBs is quite a bit more. So it forces the smaller banks into the all-day products because you can't make money on the prime products. I think it's very difficult to compete against the in DSIBs, and you can see, and I see that firsthand with First National, and the other businesses that I'm invested in are really non-DSIBs, because we're in products, they're all in products that aren't competing. I mean, an existential fear is if one of the DSIBs decide to compete in the sectors that we're in, that would be potentially very difficult, but they tend not to, because that's not their model, and their model is making money from the wealth and the cards and credit card businesses. If you get it right, are good. Wealth, of course, can be very attractive. So there's a whole range of products, and so you get back to a mortgage area, which I'm very familiar with. Is right now in the last 3 or 4 months for you in the mortgage area, there's been a rate war going on between the Bank of Nova Scotia and the TD Bank. And banks have piles of capital, they just throw it out, and they really see that mortgage product as key to the consumer relationship. You're moving, you get a new mortgage, maybe that's the time you can move your banking relationship away. Maybe we get you a card. I see that at First National when we do renewals. Our renewal rate would be in the mid to high 70s. DSIBs would be high 80s, and I know what's happening is that the primary bank is scooping that at renewal. They do something, and the classic line we hear, we see your mortgage is coming up for renewal in the fall or next year. I guess we can have that renewal, can't we? And yeah, I guess they do, and off it goes. You know?
What's your approach to competing with such a monolithic competitor like that?
So I think our approach at First National, and it applies to home equitable as well, would be a concept of, we use mortgage brokers, and mortgage brokers provide a legitimate value proposition to the consumer. If somebody asks me for a mortgage, I generally refer them to a mortgage broker and say, go to this mortgage broker, they'll assess your needs, and they'll put you in the best product. And if that product ends up being at back in the Smith Financial universe, that's great, but maybe it's somewhere else. And so there's a legitimate value proposition for having a broker who's providing independent advice to the consumer versus, let's say, an in-house salesperson, which would be the bank salespeople. But they're very tough competitors, because they tend to be, let's say, a little bit more market share focused than price and profitability focused.
Too tough? Does this situation, the structure that we have in Canada, demand a policy response that might loosen up or allow for some competition? Or do you think it's just the role of clever entrepreneurs like you to figure out a way to do it?
Well, it'd be more a thing that the way we approached it in Canada. In 2008, of course, we were all very happy and proud that we had all these Canadian banks that didn't blow up, and we came out of the financial crisis. The Royal Bank of Canada is now a leading bank as a result of being strong through that process. All the Canadian banks are good. That gets into a policy issue. I think you get into policy issues about what type of capital should we have at our financial institutions. I think in a broader sense that tends to be more a global issue and a global policy, where I think globally people are, go to the Basel framework, generally we're looking for more capital. The more capital you put in banks, of course, that is a drag on the economy because it means you need more equity. So in a way, it's a transfer from a consumer. I mean, it's interesting. People think, oh, the banks have to have more capital, so you put another 50 basis points in your domestic stability buffer, and it's crept up over time. Well, in the end, that is money that has to come from the borrowers. So you're charging more interest rates to borrow to maintain. Now, the banks have suffered over the last decade, and the ROEs from a decade ago or 15 years ago would be in the mid to high teens, and now in the mid low teens to 15. So that's a tougher policy issue.
What's your take on open banking? Is that something you welcome? Something
you know,
that's
I'm
overhyped?
a little bit indifferent. I recognize the audience here. I think would feel that this is going to be a great way that's going to be advent a big change. I don't think so.
Why not?
Well, I just think the banks are pretty tough competitors as they are. They have good products, and I think there's a little bit of a myth is they're not offering good products, or we can offer something better. No, they're tough. The banks are very tough competitors. So sure, you can have the information to the consumer, but you have that information now. Maybe it's not quite in the format you like, and it's easier, but you have that information now. So you have to have a value add to the consumer. The banks. A lot of people say, oh, I hate my bank. Well, no, they hate their bank like they hate their parents. They hate the banks, but they trust their parents. And when they have a problem, who do they go to? You go to your parents, so you go to your bank. And how many people are so proud, oh, I went to the bank and they gave me a quarter off, or I went to the bank and they did. Everyone has a convincing story that they're decent, that they have this personal relationship and they're doing just special deals for them. So I don't think open banking is going to unleash this tsunami of business for alternatives.
Okay. Let's pivot to the economy, the broader economy. Lots going on there right now. It does feel like we're having a bit of a moment. Maybe just start generally with your sort of take on where we're at or where we're headed, sort of the short term. I was doing one of these fireside chats just last week with Joe Canavan, the angel investor. He surprised me a little bit. He said he felt like we're in something like a recession. Now, I don't know if he meant that we're technically in a recession or definitely in a recession. It might have been more of just a feeling that things just aren't rolling the way they should be. What's your take?
Well, I guess I would have a concern just generally. We were talking about this and the productivity issue before we got up, and there's a lot of chat about productivity. Caroline Wilkins highlighted, well, this is a problem that goes back to, I would say frankly, when the Liberal government came into power 2015, and I think they essentially, starting in 15 and 16, put a sign in, Canada closed. We talk about industrial policy where we're spending billions. I mean, 50 billion for battery plants and 20 billion here. I mean, crazy numbers, yet where's Canada's traditional natural advantage has been for 150 years? It's been in natural resources. Now, we're all focused on getting the economy green, but that's going to be a long-term process. But just outside of just petrochemicals, we have a whole range of natural resources that we've been the miners. We've been the miners of the world. We have lots of natural resources here. Try to get a mining permit. Big investors in respect to natural resources don't invest in Canada anymore, and they stopped that in 2016. And Canada used to be the mining place for mining capital because there was a lot of money that would go into Canada and throughout the world, and that's disappeared. So I think we're reaping the productivity declines as a result of decisions that were taken in 2016. And I mean, that's 15 and 16. And that's 9 years ago or 8 years ago now, and those are starting to kick in. And when you say we've had our competitive advantage in extraction, you don't make that up by saying, oh, we'll build a plant. You really are losing your competitive advantages in that. Then you're actually having to bribe or pay people to come and keep our jobs. That's not sustainable over the long term. And talk to any global miner, and that'd be simple. Well, I can't even think of Canada. You can't get a permit, and it's not even just the timeline. Maybe if you knew it was 10 years, but you really don't have an idea that there's a path that you could come and you'll be in 2 or 3 or 4 years. It's uncertain. Don't know what's going to pay out. It's going to be very expensive. There's uncertainty. There's a lot of political intervention. It's almost like we don't have the rule of law with respect to natural resources. So that's a big issue. And then I guess other moves, the taxes on the, and I think a lot of entrepreneurs here, of course, the capital gains tax tends to, that in itself, maybe not, but the point is it's just at the margin. Personal income taxes, I think another thing I was struck back in 16 when the personal tax rate, at least here in Ontario, moved from that 49% into 53%. And the number of people said, I get it at 48, 49, I support universal health there, I like being a Canadian. 53, that's too much. And I think also the narrative that goes around that, the stoking of the class warfare, you're not paying your fair share, is offensive, I think, to anybody who is paying your taxes and has been a proud Canadian. And so there's all those factors that, and once again on the capital gains tax, where it's not competitive with other jurisdictions, and the narrative associated somehow you're not being a good Canadian or you're paying your fair share. I find that a little bit offensive, that I'm not paying my fair share. I think I pay more than my fair share, and I think we all do. And of course, it's all obviously a normative call on what the appropriate tax burdens are, but it's starting to strike me that we're getting up into the range that when people start to make decisions, I think we're all seeing that also with our children. More and more. Generation ago, you wouldn't hear about it, but now I hear more and more people, their children are graduating the university. One, either they're going to the States for university and they're staying, or they go and they get an MBA and they get a job and they don't come back, because the salary differentials are starting to become quite substantial between Toronto and places like New York, and you saw that in the pandemic. I mean, maybe lawyers aren't the best example, but factors of 2 and 3 in terms of comp, and of course the costs you can't compare, but just on balance, and that's affecting because of productivity as well. So I'm a little bit pessimistic in that sense.
I'd like to pick up on your point about the offensiveness of the tax change. Help me out with why that's important, because I think probably folks in Ottawa would say, yeah, okay, sorry to offend, but you guys are tough by the nature of what you do. You chose a difficult path, so we're sure you can suck it up and
Sure.
carry on.
Of course
So,
you can.
but I don't mean to. But it's an important point, and I'd just like you to develop it a little bit,
Well,
like why that matters.
I think the important point would be is at Smith Financial, we sit down and we have a capital allocation, and we look at private investments here in Canada, and we look at private investments in the United States. And you put everything into your model, and now the capital inclusion rate has gone up by 1/3. So that's another 10 points. Well, that's going to make investments here just less competitive. I think that's the best way to look at it. Don't take whether you can afford to or not. it's a situation is you're just not competitive with other jurisdictions. And if you start to be not competitive with other jurisdictions, then capital migrates. Now, you're on the other side, you say, well, you should be paying more, we think that's appropriate. Well, and then there's the reality is better a little bit than none at all. So you certainly at the margin, you'll get people not investing here in Canada as a result of that, and just generally. And it's often tough to measure, but CD Howe's did a lot of work on terms of, and there's a lot of academic work done when you start to move on personal income tax rate, tax stuff. And there's, you see, you look at the studies and you think, yeah, they're very, because you can argue a couple sides of it, it's very difficult to get the studies, but I just know from the way you look at things, you increase the price of things, you buy less of them, or you can't sell as many. And if you reduce the return, people will invest otherwise. And there's a certain, I guess, I think the government not to be fair, but they don't have. I don't think they're particularly sympathetic to business. And I don't think they really understand business. I don't think they really understand that actually to have the wealth that we have a universal healthcare system, or that we can have a pharmacare system, or that we can have support daycare, or dental care, and the whole range of products that we think that makes Canada a better society, you still have to have the businesses that provide the employment for Canadians to give them the income. And if you start to take that away, you won't have that any longer, and you go from just less and less and less. And I think we've been seeing that in the last 9 years, where can't do natural resources. Okay, we won't do any more carbon, so that starts to have a cost. I think we're getting the hook, Kevin.
We're getting close. So either we have 3 minutes left, or are we getting the hook? Come on, one more.
To be honest, I give you another.
Don't make me write a mean column about you, Gary. I'm going to do one more question. As much fun it would be to continue role playing as Chrystia Freeland's chief of staff, I'll leave the capital gains aside and ask you one more question. I think it's important. I know from some of the outreach that I've received just in the lead up to this conference, there's lots of entrepreneurs out here, people who are trying to put a flag down in this business. I mean, you're one of the great Canadian entrepreneurs, and you started in a time, I mean, as tough as it might feel right now, I'm pretty sure when you got started, it was, the macro environment was probably tougher than this one. You can state that for yourself if you want. But what kind of advice would Stephen Smith today give Stephen Smith who's starting out 30, 40 years ago?
Well, I wish I hadn't thought of that. That's a good question. I hadn't thought of an answer for that one. I guess I give that to any entrepreneur. Try to get a good idea, work hard at it, persist. Really test your idea. Try not to get in love with the idea too much. Try to be disciplined about it, because I would say, it's interesting. I'm going to come back again next year, because I've been interested to see lots of different ideas. But I would, if I see, I think there's a lot of fintechs that think because it's fintech it's going to work, but you're in a financial services space, and balance sheets are pretty important. And we can see that with the Canadian banks. They have big balance sheets, and they have lots of capital. So very hard to disintermediate them. Just because you're a fintech doesn't mean that you're going to displace established players. Have a good idea, keep working on it, work hard, focus. I can just remember First National. It was years and years and years before we made money. It was hard. I look back, and it's the question I remember. I said, when we were starting out, it was so much easier 15 years ago. And I'm sure people are looking back, it was so much easier 35 years ago. Probably was, But it's. I think every era presents new opportunities, and I launched Merlin, which was an online underwriting system back in 2000. And I mean, that was it's 24 years ago now. It seems like yesterday, and I wrote the code myself, and it enabled brokers just to go onto our website and track the status of their mortgage, which was quite innovative at the time. And so there was an opportunity that presented itself that gave First National a competitive advantage, to which to some extent still persists today. And I think in your own way, and hey, there was no apps then. I mean, that was written in, I wrote that in VB6. So if you can, yeah, that's right, exactly. And so I think in many ways, like any new, I think there's always lots of opportunities going forward, and you just have to move with the time.
All right, thanks, Stephen.
Good.
You get that, Gary? We're coming back to do this next year.
We are, I heard that.
An hour, though, next time. You know,
An hour next time.
An hour.
I knew it would be too short.
I'll be back.
Yeah. Thank you so much.
Okay. Thanks, everyone.